FMC indicators give an indication that things are getting much better. Kharif crop sowing has improved over last year. Higher water levels in the reservoirs by better monsoons augurs well for the upcoming Rabi season. The GST collections in the recent quarter Q2 grew by 7.7% year-on-year. Manufacturing PMI and services PMI continue to gain momentum. On the consumption side, the private consumption growth rate in the recent reported quarter at approximately 7% has picked up from the prior quarter and last year trend levels. We see that in some of the card spending, which is very robust. RBI, while the policy rates have been kept unchanged, has given relief in the form of CRR, the first of which kicked in September, and in a phased manner, it will be completely phased in by end of November. We expect India's GDP growth rate to be between 6.6 and 6.8%, driven by good demand recovery and consumption improvement resulting from various reforms that I had alluded to. Now, getting to the certain key bank metrics, advances under management as of end September at rupees 28.7 trillion grew by 2.4 trillion or 8.9% over prior year. On an average basis, the same grew by 2.3 trillion or 9%. Mortgages, it is across the board growth rate. The mortgages grew by 6.7% year on year, about 53,000 crores. Retail advances, excluding of those mortgages, grew by 8.4% year on year. Small and mid markets advances grew by 17% over the prior year. Corporate banking, that includes the ECG, grew by 6.4% year on year. Our CD ratio as of end September stands at 98%. The total deposits as of end September at 28 trillion grew 3 trillion or 12.1% year on year, and same on an average basis grew by 3.56 trillion over prior year or 15%. Current accounts grew by 7.6% over prior year. Similarly, the savings account also grew by about 7.3% over prior year. Our CASA ratio remains steady at 33.9. Term deposits, which aggregate to rupees 18.5 trillion, grew 2.4 trillion or 14.6% year on year. Our branch network stood at 9,545, an increase of 453 branches since last September, and we added 46 branches in the quarter. Payment acceptance points are at 5.6 million, 11% growth year on year. Rural presence slightly increased to 2.5 lakh villages right now, and we are focused on deepening relationship across these villages. We added 1.5 million new customer liability relationships in the quarter. Customer base stands at approximately 99 million. On cards, we issued 1.5 million new cards in the quarter. Total card base stands at 25 million. Balance sheet remains strong and resilient with the LCR ratio for the quarter at about 120%. Capital adequacy ratio is at 20%. Total capital adequacy ratio. CET1 is at 17.5%. Now turning to revenues, net revenues for the quarter were 459 billion, grew 10.3% over prior year. Net interest income for the quarter at 316 billion rupees grew by 4.8% over prior year. The core net interest margin for the quarter was at 3.27. On an interest earning asset basis, the core net interest margin was at 3.44%. Moving on to other income, the total other income was rupees 144 billion. Fees and commission at 88 billion grew by 8.5% over prior year. FX and derivatives income at 16 billion is higher 9.2% compared to the prior year period. Net trading and master market income at rupees 24 billion for the quarter. Prior quarter was 101 billion, and as you know, that included gains from the IPO proceeds of HDB Financial that we participated in. Other miscellaneous income at rupees 15 billion. That includes recoveries from written off accounts and dividends from subsidiaries. Now moving on to expenses. Operating expenses for the quarter were at 180 billion and an increase of 6.4% over prior year. The cost to income ratio for the quarter was at 39.2%. Moving on to the asset quality. The GNPA ratio was at 1.24% as compared to 1.40% in prior quarter and 1.36% in prior year. The GNPA ratio excluding NPAs in agricultural segment was at 0.99. Prior quarter was at 1.14. The net NPA ratio was at 0.42%. Prior quarter was at 0.47%. The slippage ratio for the current quarter is at 25 basis points, about 74 billion rupees, as against 34 basis points in the prior quarter. Then moving on to the provisions, the total provisions charge were around rupees 35 billion in the quarter. The provision coverage ratio was at 67%. In the quarter, the total stock of the provisions, when you look at that, the contingent and floating provisions were approximately rupees 381 billion, with contingent provision adding to rupees 167 billion and floating provisions at 214 billion. General provisions were at 113 billion. This is the stock of the provisions. Total provisions comprising specific, floating, contingent, and general were about 211% of the gross non-performing loans. This is in addition to the security held as collateral in several of the cases. Floating contingent and general provisions were 1.78% of the gross advances as of September end. That was 1.77% as of last quarter end. Getting to the analyzed credit cost ratio, for the quarter it was 0.51%. Prior quarter was at 0.56%. Recoveries, which are recorded as miscellaneous income, amounted to 14 basis points of gross advances against 15 basis points in the prior quarter. Getting to profit after tax for the quarter was rupees 244 billion, grew by 11% versus last year. Net profit after tax for the quarter at rupees 186 billion, grew by 10.8% over prior year. In summary, the results have come from a strong contingent of 220,000 people working with about 99 million customers, delivering average advances under management growth of 9% or rupees 2.31 trillion, and gross advances growth of 9.9% year on year, 2.5 trillion. We built deposits on an average 3.56 trillion or 15%, and 3.02 trillion or 12% end of period. Profit after tax, as I said, rupees 186 billion, increased 10.8%, which delivers a return on asset in the quarter of 1.9 and return on equity at 14.4%. Earnings per share in the quarter is at rupees 12.1 on a standalone bank level and rupees 12.8 at consolidated bank level. The book value per share stands at rupees 340 and at a consolidated bank level is at rupees 353.6. I want to take this opportune time to wish you all a very happy festival time with your family and friends. With that, may I request the operator, Neerav, to please open up the line for questions.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Please note, participants are requested to restrict to 2 questions per participant and kindly join the queue for a follow-up question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Thank you, Neerav, once more. And as you assemble the queue for the questions, we have our Managing Director and CEO, Shashi Jagdishan, with us. I'm going to request him to give a few strategic comments for the benefit of all of us. Please, Shashi.
Thank you, Srini, and thank you all. Good to be on this call. Let me first wish you all happy festivities, Shubha Dhanteras and Shubha Deepavali. Let me just summarize a few points. Srini has covered a lot in his opening remarks, but just two takeaways. One, the triad of the tax benefits, the GST, and the interest rate cuts seems to be working as we see at the ground level, economic activity visibly improving across customer and product segments. In this background, we have an opportunity to accelerate loan growth, which is what we have started to do from this quarter. We believe that this will sustain and continue, but of course, we have to wait and watch. If you recap, the bank had charted a growth trajectory, namely slowing down growth in FY25 so that we could bring down the credit deposit ratio from a high of 110% to 96.5%. The 110% was at the time of the merger, which we did. We also had a trajectory to grow in line with the system for FY26. We seem to be in line with that particular path. And we expect, we believe and we expect that we will grow faster than the system growth rate and gain market share in FY27. All in all, the way we are positioned, both from a capital perspective, from a distribution perspective, from a managing all the matrices, we believe, and the fact that what we are seeing at the ground level, we seem to be on path with that trajectory. We've also done this by maintaining immense stability in some of our key financial matrices, whether it is NIMs, cost to earnings, and even return on assets. NIMs obviously will have a kind of a quarterly changes because of the fact that the asset side of the balance sheet gets repriced faster and the deposit repricing will happen with a certain amount of lag. So you will see some tailwinds on account of deposit repricing happening in over the next couple of quarters to a year. Our USP has been our asset quality. We continue to maintain a very healthy quality, and we've seen some of these asset quality matrices being range bound for a long period of time. We continue to invest in technology, distribution, and that these are all investments for the future. And a large part of our investments thus far in technology has been in core platforms, middleware, and some of the emerging technologies, including Gen AI. Talking about that, I think let me just slightly elaborate. We have set up our own factory in terms of what we do for some of these emerging technologies. We are undertaking a few lighthouse experiments, which primarily is to re-engineer our processes, reduce our turnaround times, create a wow customer experience, and at the same time have a quantum change in tangible benefits to the organization, to the bottom line over 18 to 24 months. So this is something that we are silently executing, and I think at the right time we'll call this out as to what we are doing on that particular space. But I think the broad strategy that we had envisaged sometime last year is on track, and we are quite excited to be in the sector, in the country, in terms of the inflection point that we are seeing at this point in time. Thank you all, and once again, wishing you all a very happy Diwali and a happy Dhanteras. Thank you.
Thank you, Shashi. Nirav, with that, just get to the queue and please bring on, please.
Thank you. First question is from line of Ankur Mishra from ET Now. Please go ahead.
Thank you so much for the opportunity for asking a question. Mr. Jagdishan, I'll start from your commentary because you mentioned that till FY27 you have a growth path. But for particularly this year, when you have achieved 10% loan growth, can you end the year with a double-digit growth?
So, I do. I want to take that question. See, the point here, Ankur, is that we will grow in line with the system for this year, FY26, and we will be faster than the system in FY27, like what we have been talking about for the last 1.5 years or so. The strategic direction that was set at that time continues to be in play, and our trajectory that we are in today shows that we are progressing towards that objective. I do not want to give one number of what that, whether it is a double digit or whatever the digit, because we don't want to give an outlook. But all we want to tell you is that there were certain strategic directives set, and we are in trajectory to get to those strategic objectives.
Operating expenditure per se has increased 6.4% per se. I want to understand where it is coming from, or do you think that in the second half of the year that will be contained?
Mishra, can I request to unmute your line, please?
I want to understand about your operating expenditure front. It has increased 6.4% if I talk about this quarter. But in the second half, do you think that there will be reduction here, and where it is coming from in this quarter?
Okay. Listen, this is part of various investments that we have done over the last 3 years. And if you look at the branch addition, almost 40% of our branches that we added, 40% of the branches that we have in stock today have been added in the last 3 to 3.5 years or so. Now, we are focused on driving productivity from those branches, productivity in the form of both better customer engagement and bringing on new customers. I told you about the 1.5 million customers that were liability relationships that were added. We are at about 99 million customers or so in aggregate. So we are trying to drive that operating leverage where the top line growth outpaces the need for investments. And also I mentioned that our branches over the last 12 months grew by 450 plus and 46 branches in the quarter. So somewhat that is moderated compared to what it was in the past, but still a significant addition to branches that we are doing. So investments are ongoing, both branches, people, and technology, but at a pace which is lower than what it was in the previous period. So you're seeing a comparative number there, and as the operating leverage kicks in well, you're seeing the cost to income at about 39.5 or so.
One last question, if I can ask, regarding the margins front. Yes, there is some deterioration on QOQ front, but overall you have maintained a kind of guidance which you had given. So you think the pressure on the margin will continue in the second half as well?
See, there are two things on the margin. One is we do not know what the rate scenario will be because from various estimates, while the rates are held steady right now, the policy rates movement is an item that we will have to take it as and when it comes, right? So we can't bring that into account. But save that to the side. Apart from the policy rates, as we told you, the rates on the loans, prices, 70% of the loans are floating rate, and the prices, the 100 basis points, the price change on that has happened. And for most part, it is there by September, it is factored in. Some more, whatever the full quarter impact is not there, will flow through in December or so, right? And any further policy rate change, we will have to handle it as it comes. And deposit rate, as I mentioned, as well as Shashi had alluded to, is a managed rate, and it takes almost 6 quarters to flow that through. We have changed the savings rate by almost anywhere between 50 to 75, depending on the value of those deposits, slabs that we did. And when you look at the time deposits, we have reduced that by almost 70 to 80 basis points or so. So that takes about 6 quarters to come in. A little more than a quarter has passed where it is factored in. So you are seeing in this quarter, if you look at our reported results, our cost of funds is lower by about 18 basis points, but the yield on assets were lower by about 27 basis points or so. That's what you have seen there. So yes, the cost of funds will, over a period of time, get that benefit of the rate changes that have happened. But we'll have to be patient to work that through. Again, don't look at it quarter to quarter because that's not how we manage. There will be some quarters where it can be up, some quarters it can be down. That is function of various activities that happen and the pricing that happen to meet the customer demand and to meet the customer desires and engagement. So don't look at quarter to quarter, but on a yearly basis, yes, we do think if you look at the 12-month period, 24-month period, NIMs are expected to be stable to going up.
All right. Thank you so much and congratulations to the management for the decent quarter.
Participants, kindly restrict to 2 questions per. From line of Piyush Shukla from Hindu Business Line, please go ahead.
Yeah, good evening, Shashi sir, Srini sir. I want to understand, there's a sort of a nice growth that has come on corporate loan side, which was not till last quarter. There were pricing issues. I want to understand whether private capex is picking up. In terms of pricing, how have things improved? Are corporates moving back bank loans because of lower rates than debt market? Just some commentary on that. And separately also, Shashi sir, this acquisition financing draft guide, the draft that the regulator will issue. I want to understand how do Indian banks have an edge over, will they have an edge over foreign banks on this front? Because traditionally they have been engaged in such activities. How do you look at this as an opportunity to grow further, and whether in terms of your what existing corporate clientele, have you already started receiving such requests? I mean, just some color on acquisition financing. And also on credit growth, if you could give me some guidance. You mentioned that there are many levers, macros that are playing out well. But for the full year, any guidance on credit growth front? Thank you.
Okay, yeah. There are a few things that you touched upon the wholesale loans. See, it has to be looked at in 3-4 contexts. First is that when we were working through the balance sheet repositioning, the pricing on the wholesale we noticed and we saw that was extremely competitive.